Back to the auditorium. The next, we will have two panelists. Most of them are so famous in this country, so there is no need for me to introduce them to you. So let's welcome the first one, Professor Wu. Please.
，Mr. Chairman, Professor Waller, and Director Jen, ladies and gentlemen, good afternoon. It's my great pleasure to have this opportunity to participate in this workshop. As mentioned by Professor Waller, some of the recent economic thinking may need to fine-tune. And following, I will just present some of my questions and observations about the recent development of monetary policy in the United States. Figure 1 is the historical data of federal fund rate since 1999. According to the document of National Bureau of Economic Research, from the period January 1999 to December 2014, there were two major recession periods. One was from March 2001 to November 2001, and the other was from December 2007 to June 2009. And if you look at the federal fund rate in these periods, you may notice that the Fed lowered the federal fund rate from 6.5% to 6% on January 13, 2001. And the similar phenomenon happened again in the second recession period. The Fed decreased the federal fund rate from 5.25% to 4.75% on September 19, 2007. And both periods, the Fed lowered the interest rate about 3 months before the peak of that cycle. As you know that from the literature, it takes about 3 to 6 months for the effect of monetary policy to show up. So in terms of timing, the Fed actually performed quite good in those periods. After the outburst of the financial turmoil, you all know that the federal fund rate decreased sharply to 0 to 0.25% on December 16, 2008. And not only lower the interest rate, at the same time, the first round quantitative easy monetary policy was launched on March 18, 2009. If we look at the Industrial Production Index of United States, it's easy to know that after the mid of 2009, the economy actually showed a very strong recovery. And however, for the unemployment rate in that time was at a very high level. Therefore, on November 3rd, 2010, Fed announced another second round of quantitative easy monetary policy. After 2 rounds quantitative easy monetary policy, you can see that in this period, the momentum of economy actually maintained a stable trend. And the unemployment rate declining a little bit. However, the inflation rate was showing up during the period May to September 2011. In order to avoid the further inflation pressure, the Fed just stopped the quantitative easing monetary policy. They adopted the Operation Twist policy, which was buying the long-term bond and selling the short-term bond on September 21st, 2011. Later on, the inflation pressure gradually come down and resume a normal level. And in order to further stimulate the economy, Fed announced third round quantitative easing monetary policy on September 13, 2012. So from the above discussion, I may conclude that the timing of the Fed's monetary policy was accurate, and the procedure of the monetary policy seemed to be consistent. And the short-run stimulative effects of losing monetary policy on the economy appear significant. However, I have several questions. Let's back to the federal fund rate table figure. From the year 2001 and 2003, you can see that the federal fund rate low from the 6.5% in the early 2001 to around 1% in the mid of 2003. If we calculate the average rate of the federal fund rate from the period 1991 to 2000, the average rate was about 4.95%, close to 5%. And the first question I have is, why interest rate reached so low during the period 2003 to 2004? Especially if we look at the economic momentum after the third quarter of 2003, the economy already showed a relatively strong recovery sign. And why the Fed still kept the interest rate at such a low level and maintained such a long period of time. The second is that if we look at the real estate market performance, during the period 1999 to 2007, it's easy to notice that the real estate market actually is quite good. They were showing up. However, why the showing up real estate market combined with the low interest rate did not cause any concern by many brilliant minds? Were there a time inconsistent problem? Okay, let's back to the data of recent year. Okay, I'm sorry. After the 2012, the economic performance actually maintained in a moderate level, not so strong, but not so weak, as mentioned by Professor Waller, about 2.5%. This is a moderate growth. And for the inflation rate, it's not of concern. How about the unemployment rate? Unemployment has been keep declining. And in February 2015, it reached 5.5%. Therefore, Fed just stopped closed the quantitative easing monetary policy on October 29, 2014. However, people are worried about the labor market seems to still have some problem because the labor participation rate is low, and there is a distribution problem among the unemployment rate. That means high-skilled labor, the unemployment rate is low, but for the low-skilled labor, the unemployment rate is quite high. And for the young generation, also relatively high unemployment rate. So if you have this kind of thought, then you had better to keep the interest rate at a very low level. So we see that the interest rate still maintained at a very low level till now. However, the problem I have are, first, maintaining such a long period of low interest rate environment and this lengthening financial leverage will not cause any trouble in the future. If we look at the asset market, I'm sorry. If you look at the real estate market, the real estate index for the United States, now they reached to a level which just a little bit below the peak level in 2007. How about the stock market? The stock market already passed the peak level before the crisis. Now it's more than 19,000 points. So the question I have is that diverging movements between the real and financial sector can last how long? Which one will adjust? People always have excuses to delay the increase of interest rate. Even it does increase in the future, people are expecting it will increase at a very low magnitude. They just want to enjoy more happy hours. And you have to notice that it's not only the phenomenon exists in the United States, it exists in many countries, especially those leading countries. And the problem I have is that will the story repeat again? This is the end of my discussion. Thank you for your attention.
Thank you, Professor Wu. May I ask Professor Wu, the 5 questions you list here, are you directing those questions to Professor Wallet or the audience? No. But anyway, you can answer those 5 questions first at the floor discussion. Well, then let's welcome Professor Liu. Okay.
Our moderator, Xi, and Professor Waller, and ladies and gentlemen. It's a very happy occasion to be here today, this afternoon. I haven't been here for quite some time and almost got lost. But anyway, I'm very happy again, and thank you for asking me to be here today to share with you some view regarding the monetary policy. And I originally really intended to try to make Professor Waller's speech, and unfortunately I got something caught up, and but I did read his PowerPoint page by page. So so I think that I did not prepare any PowerPoint myself, but I would like to share some of my thoughts, and maybe we can have more discussion later on. I think regarding his title, The Monetary Policy in the 21st Century, I do agree very much with the 3 thoughts that Professor Waller mentioned, and especially told us, I guess on the speech is the same, told us that we should forget about all those 3, quote, the conventional thoughts about monetary policy. And I think it's also very true that in the beginning, when we have this QE procedure, that people were really worried about inflation, and that's why in the beginning, especially the beginning of 2009, I mean the beginning of the QE started, that many people flooded their money into something like, say, gold to prevent the case, say, when inflation comes up after the QE, and then they can, well, at least protect their assets. But as we all know, that it became a puzzle later on, that why the people print so much money, but somehow we did not see inflation. And of course, that I would say, I do agree that we can forget about the Phillips curve, but I also would like to add on that Professor Wu President Wu just mentioned regarding the stock market as well, that we see, I think that we don't see inflation in general, but we do see asset inflation. That's indeed true. So I just feel very puzzled about like how this word will become for the future, because it's definitely not a healthy status. And so regarding Professor Waller's mentioned the remarks, I do have actually also one question though, which is that when Professor Waller mentioned when the government, or say the central government, when they print money, it's actually printing the difference between printing money or say buying the government bonds. You mentioned that it's a similar, the different format of government's behavior. But somehow even though I do agree that both are liabilities of the government, but I think that there's still quite some difference. And maybe that's the difference, that's that particular difference which makes difference why that at least, like for the US, we see QE started the earliest, that we still see some effects. And to be specific, that if we look back the year of 2008, people were so pessimistic, and for those government bonds, really nobody wanted to buy it. And after Lehman, people even didn't have that much confidence, even for the government bonds. So if it's not because of U.S. printed so much money to buy those bonds, and definitely I think at least for the corporate bond price would be really tumbling, and that's no good for anybody. Or say, put it differently, I think the QE effect throughout this past 6 years, the most effect maybe lies in the fact that it gives people confidence. Because for economists, we know what's going on. We know that this is no difference. The liability when central bank prints money, or the liability when government have this government bond. Both are liabilities, true, but that's from economist point of view. For general public, they don't know they don't know these two are the same thing, because when they see the money printing out, they don't see that's a liability for the government. They see that's an asset. Or in some way, that's similar to Robert Lucas' island theory. They are confused. So when they see the money walking around everywhere, and they also, in the meantime, they see the price of the bonds got this support because of QE, and they feel confident about it, and they are happy about it, and then so the resumed confidence bring people's confidence back. They started to still, they invest, they consume. So I think in that sense, QE really has some effect, even though that's not for real, but it's very ironically, it does bring some real effect. So one is because of this misleading guidance, which is the good side of this misleading effect. That's one thing. And second thing is also when we talk about that, even though we don't see the inflation, but we do see the stagflation. And this stagflation, again, I think that's very ironic, and but that somehow brings a lot of happiness and bring a lot of confidence, because the stock prices, especially for the US, really went up so much, or has been going up so much, and that brings a lot of creates a lot of wealth effect, and wealth effect is for real. So again, QE is not really creating something for real, and it's not really creating something for output, and they don't do that. But the wealth effect is for real. Again, it's only because that it gives people confidence, because they are not economists. Not everyone is economists. They don't know this is something that actually doesn't do much about it. So coming back to my point I wanted to say is that I think it's a very interesting question and worth further research. Maybe we leave it like 10 years later that we can talk about this issue and try to find an answer later on, which is that, is it, or say not is it, not 1 and 0 question. It's like, to what extent that because US was the first one which started QE, and like Euro did not do QE until this year, so late, it's like 6 years later. To what extent that contribute to the US recovery? Even though that's just a misleading signal. But as I said in the beginning, I've been wondering really that misleading signal may really create something for real. And that's, I don't know how we should feel about it. It's in some sense that's government's cheating behavior, but somehow it works. It's sort of like somebody has fever, and your doctor keeps on saying that you're fine, and you think you are fine, and you still eat normally, and you feel happy about it. You sleep, tight during the night. In contrast with doctors told you that actually you are probably, that's it. And then you couldn't eat, you couldn't sleep, and then indeed, that's it. So in a way, that's something that I feel, I really don't know the answer, but I feel that when we see the Euro, and I think it's very interesting because Euro just started the process, and we see sort of like similar to what not sort of, actually it's quite similar to what U.S. been through, because we see this year, or even started late last year, that we see the money goes from everywhere to Europe, and we see their stock market performance. And a lot of European people or Euro area that they feel good about it, and people have confidence, and that may bring something for real also for this year. It's only April now, so still wait and see. But I just feel that that really gives us some very misleading and kind of uncertain and unknown issue, and analytical-wise, it's very interesting. But we really don't know where this is leading to, and whenever we run into a crisis, what's the best policy for government? I just think that's very interesting. So to share with you. Thank you very much.
Thank you, Professor Liu, for your valuable comments. You also raised some questions, which I know are common to the audience. So you saved the trouble for us to raise those questions again at the floor discussion. Now, well, may I invite 3 speakers to the stage, and we will have the floor discussion. Since the 2 panelists had already raised some questions and made some comments, may I invite Professor Waller to have some response to what they say? Yeah.
So, let's see, I'm trying to remember exactly what the questions were. All right. So there's, going back in the pre-crisis time, the run-up in housing prices, if you notice on the chart, it actually started in about 1996 in the U.S. That was the bottom of housing prices had been stable, and then they took off. There were a bunch of reasons for that. One of the big surprises, John Taylor's become famous for saying the Federal Reserve caused the housing crisis by keeping interest rates too low for too long. Well, if you look at that chart, housing prices had gone up about 80 or 90% before we did anything. So there was a housing bubble going on long before the Fed made a decision to lower interest rates. If you remember, Alan Greenspan at the time was talking about this conundrum that the Fed raised its policy rate from 1% to 5.25%, and U.S. mortgage rates didn't move. And he called this a conundrum. Housing, the interest rates for buying a house stayed right around 5%. And Greenspan said, we're in a conundrum because the interest rates, mortgage rates should be going up, and they're not. This was the thing. The Fed was raising interest rates, yet housing mortgage rates didn't change, and housing prices kept going. So there was a question, could the Fed do anything about it? The other thing was there was a very strong debate in the U.S. Everybody saw it. It wasn't like the Fed was asleep and woke up one day and these prices were really high. But there was a huge debate whether prices would do this and then flatten out, or they would go up and then come crashing down. There just was a widespread belief that U.S. housing prices across the whole country couldn't come down. Nobody believed it. Financial markets didn't believe it. Economists didn't believe it. I didn't believe it, and I wasn't at the Fed. It was just, we hadn't seen anything like that since the Great Depression. Well, the Great Depression should have taught us something that, yes, they can go down across the whole economy. So if they had just kind of leveled off, it's not clear how severe the damage would have been. So let me address another issue that there's been a significant run-up in stock prices, equity prices in the last few years. And this is, again, has been something there's been tremendous debate within the U.S. and among my Fed colleagues and I, which is we know that if real interest rates or interest rates are pushed down, asset prices go up. This is just basic finance. The question is, are those rates being artificially kept down by the Fed or the central banks, Or, as I was alluding to at the end of my talk, there are global forces that are pushing them down. If it's the global forces pushing them down, then the global forces are the source of the run-up in asset prices. So it's very hard to disentangle who's doing what that's causing this run-up in asset prices. My boss, President Bullard, was in Europe 2 weeks ago, and he was starting to raise concerns that he's starting to get concerned about asset bubbles as well. In the U.S., I can't speak for everybody else, but in the U.S., one reason the asset prices have been running up is U.S. firms had record corporate profits for a number of years. So anytime you have large increases in your corporate profits, the asset price is going to rise. So we used to look at price to earning ratios, and up until about maybe a year or so ago, they weren't that far out of line. But in the last year, they've continued to get closer, kind of up into worrying areas. So I think everybody's kind of starting to watch this. And we'll see, if the Federal Reserve lifts off this year, we'll see what kind of impact that will have. One of the things we're trying, I think, optimal monetary policy from any theoretical model says you should communicate your actions in advance, and then the things get priced in before you actually do it. So if you can Chair Yellen gave a speech 2 weeks ago today where she talked about lifting off this year, but doing it very gradually, and some of that would be you wouldn't have a large disruption in asset prices. In terms of housing prices, we had a flat spot, and then they kind of ran up, and then they cooled off in the last year. We'll see if that continues on in the year to come. Yeah, so the other thing is, this is actually a good point. I was going to mention this in my talk, that in traditional models of central banking, you try, as I had on the curve, you try to lower rates and get people to borrow. And then that stimulates demand for consumer durables. Remember that when you're borrowing, you're increasing your household leverage. And firms are increasing their leverage. What happened after the financial crisis was, at least in the U.S., all U.S. households were trying to deleverage. So everybody's trying to reduce their debt, deleverage, and what are we trying to do, or any central bank, when you're trying to lower interest? You're trying to get borrowing to go up. You're trying to get them to leverage back up. So households were trying to push down leverage by all of our normal monetary policy mechanisms, lowering real interest rates. You're trying to force them to leverage back up. So there's a sense in which there's another explanation for why things haven't worked. This idea that we try to get households or firms to leverage up and down as we move interest rates. We have to think a little bit harder about that as economists, about the role of leverage in household and firm decision making. Something that we kind of ignored in most of our models. And then these divergent movements between real and financial sector. Well, like I said, asset prices are going to stay high as long as interest rates stay low. Whether they're low because they're global forces or low because central banks are doing it, we'll find out if the Fed decides to lift off this year, whether we'll see a big correction in asset prices or whether interest rates will get forced back down. That's a movie we get to see the ending play out later this year, potentially. I'll stop there.
后来 just now, if may I invite anyone from the audience to raise questions or to make comments. Yeah, okay, please.
Good afternoon. My name is Joshua, and I have a question for Professor Waller. And the Fed has announced, I think just a few days ago, that it is going to raise the interest rate, and you just mentioned that, right? And I wonder, what's your personal opinion toward this kind of action, or maybe are you looking forward to see the impacts of this kind of action? Yes, that's all. Thank you.
Well, I'll just kind of reiterate what Chair Yellen said 2 weeks ago, or my own boss's comments. What Chair Yellen said 2 weeks ago is we've seen very significant improvements in the labor market. Unemployment's down to 5.5%. If you look at a broad-based measure of labor market indicators, they're all almost back to normal. Maybe 1 out of 20 or 2 out of 20 are not back, but almost everything else is. GDP growth the last 3 quarters of last year was growing at roughly 4%. So by any traditional measures of economic performance, real economy, labor markets, things look quite well. So in that sense, as she said, that's one of the reasons she thought 2015 would be the year that liftoff off the zero lower down would be a reality, just because the economic data is supporting that. There is concern that if we were to lift off, we don't know what kind of turbulence that may cause in financial markets, particularly if the market's perceptions of things are out of line with what we think. This has been a persistent problem. The FOMC Survey of Economic Projections shows a much steeper rise in the Fed funds rate than the markets are pricing in the futures markets. So there's a gap between what the market thinks are going to happen and what the FOMC thinks. If that doesn't get corrected at some point, that could lead to some substantial disruptions in the financial markets. We saw that in 2013 with the taper, what was called the taper tantrum in the U.S. Chairman Bernanke went out and started talking about ending QE. Markets weren't quite prepared for it, and we saw some pretty dramatic movements in interest rates in a matter of a day or so. And then on my boss's side, he's starting to get very concerned about asset bubbles, that these are starting to happen. It's starting to look kind of bad. And so we don't want to repeat what happened in the 2004 to 2006 tightening cycle, that we need to start lifting off now. The longer we wait, the more these problems are going to potentially blow up on us. So, yeah, I think as Chair Yellen said, this year looks like, but I'll stress over and over, it's all data dependent. I mean, it's clearly you're going to look at the incoming data and say, is it right to take the lift off now? And if the data softens, it's been softening the first part of this year. It may not happen immediately in June like many people thought. It could be later or later this fall. But it's all data dependent. If the data turns around, June could still be an option.
Thank you. Any more questions?
Yes, thank you for your answer.
Well, okay. Professor Chen.
So Japan has implemented the QE for 15 years, but it did not work. It seems that it did not work. So what advice would you give to the BOJ governor? And what went wrong there?
Well, they really only undertaken QE in a serious manner in the last year or two. If I recall correctly, they started to do a form of QE about 10 years ago. Prices started to go up and they immediately quit. So people argued that, they should have continued on with it, and they backed off and stopped. I think it was this monetarist fear of inflation I was talking about earlier that forced the BOJ off of that. But now with Abe and Governor Kuroda in charge at the BOJ, they've decided they're going to be bold and go out and try to do things and finally end this one way or the other. It'll be interesting to see how it goes. I mean, if going out and buying government bonds and private sector equities and real estate equity assets, if that doesn't start doing something, I'm going to resign and go back to academia.
Okay. We also have some famous monetary economists here. May I invite some professors from National Taiwan University to share your thought on the topic? Professor Wang or Professor Lee?
Well, I just want to follow up with the previous question. That is, last Friday, I remember there was bad news about the U.S. economy. I think the new job creation was lower than expected. So I don't know whether, do you think this is a small hiccup that won't affect the long run recovery, or this actually shows some signs of some unexpected turn? Because I think because of that news, the market now speculates whether the Fed would carry on the raise of interest rate as planned. Thank you.
Yes, so last Friday, the U.S. Jobs report came out, and there was 126,000 jobs created the previous month, and expectations were for over 200,000. So one comment I want to point out to people is that for roughly the last, say, almost 2.5 years, 90% of all the jobs reports were revised up in subsequent months. Back in August of 2014, the number was almost exactly last Friday, and within 2 months, it had been revised up from 120,000 to almost 200,000. So this is the tough part about doing monetary policy. You're doing it in real time, but the data gets revised. So if you go back and look at the data for August 2014, it's a 200,000 plus job report. But when we first saw it, it was 114,000 or something like that. So that's leading me to what I suspect there's a chance that the Friday one gets marked back up as we go forward the next month. Next month will be a second revision and then final revision in 2 months. So what looks bad now, a month from now, could look much better than people thought. There is a lot of concern that the first quarter economic activity is coming in soft, not as strong. GDP growth is being marked down below 2% by many forecasters. This happened last year. First quarter GDP was negative, and then we had 3 very good quarters following that. So how much of this, again, we had a very rough month in weather in February, and so is the first quarter an outlier like it was last year, or is it something that will continue on? So I think as we get into the warmer months of the spring and early summer, we'll find out whether that was a more persistent pattern or just like last year, just some weather-induced bad quarter.
More question? Yes, Professor Lee.
Yes, Professor Waller, at the end of your talk, you have mentioned that to guide effective monetary policy, we will need a model that look into frictions. So if we take this advice and we compare the effects of QE from the Fed and the QE from the ECB, and we all know that the financial environment and the frictions in the Europe and US were quite different, then how your model will guide to estimate the relative success of the QE implemented by ECB?
Yeah, so I think this is exactly what Europe has. One of the things the Europeans have faced is similar to what I described. Let me just back up. This idea I'm trying to push, it's more of an academic idea for, if you go back to the housing bubble, the thing that literally drove a lot of that was loosening of borrowing constraints on U.S. households. It wasn't some sticky price friction or lack of, it was something on the balance sheet that relaxed borrowing to where people could leverage up to 95% on a house. I mean, this is what was driving a lot of the housing price. It wasn't things in our fundamental model. So that's why I want to think about longer term frictions, and when those things suddenly relax, you can get some very dramatic effects from that. One of Europe's problems, and this has been the case for all of the banks in both the U.S. and Europe is they've been trying to deleverage after the financial crisis. European banks had just gone through their stress testing the last year, and they were trying to deleverage and build up their stock of safe assets, which means they're not going to lend. Yet the early programs that the ECB was trying to implement all was aimed at getting the banks to do what? Lend. So here the banks are trying to deleverage, go to safe assets, and the ECB is trying to take policies to make them extend loans to riskier investment projects. It's these two winds fighting against each other, and you don't see a lot of progress on anything as a result. So I think that's why the program that the ECB put in place last June just didn't work. It was only going to work as long as banks took the money and made loans, and the banks were in no interest. They had no interest in making loans, given that they were going to wait for the stress test results that came out, I think, in September or October, and they were trying to get their balance sheets cleaned up. So if it takes, again, back to these frictions, if it takes a long time to get balance sheets cleaned up, kind of short-term standard monetary policy prescriptions aren't going to have a whole lot of impact. And I think that's one of the struggles we've tried to understand.
Well, okay. Ms. Chen, that's reporter.
Sorry, I have a question. Yes, I'm from Commercial Times. My question quite easy, but it's a big discussion. As we know and we hear, a lot of the information is from academic side mentioning the QE is not efficiency, and it's a causes to the real estate booming, and the government happy because everything is going right. But actually, it's a very strong impact on society and on the welfare. So is it why the government insists to continue? I mean, from each country, they choose QE is a better policy.
Well, like I said, there is academic work that I've done, and some of the people that work with me, Steve Williamson, that QE can, even straight theoretical models, have this kind of beneficial effect. The standard academic answer you're getting is that Modigliani-Miller kind of argument that these are just swapping one piece of paper for another and has no effect. As Katrina said, there may be very good reasons that people do not view these things as perfect substitutes for each other. And if that's the case, that's what I was talking about, some frictions that people view, say, money very differently than government bonds, then you can do things with money to affect the economy. I've kind of always kind of had this idea that if we can print money and buy stuff with no consequences, we could do a lot of amazing things in the world. You know, we can just go fund all medical research, end all kinds of diseases. I mean, there is a sense in which, like I said, remember, my talk was to be provocative. But there is something to the old monetarist ideas that if you just print money and keep going and it doesn't cause inflation, why stop? I mean, this is fantastic. So the bigger, I want to address this, well, actually, I'll give a quote Chairman Bernanke actually said. He said, QE is something that in theory doesn't work, but seems to work in practice. So I think that's the kind of academic view, is it can't have any impact, and then if you look out, you go, well, maybe it did have an impact. I think the bigger question is, like I said, we get this criticism all the time, and I think every central bank does. You guys are driving down these interest rates, keeping them down, and you're killing savers and hurting wealth accumulation, and this is terrible. Well, again, who's driving the interest rates down? If it's global forces, you know, what can I say? If everybody in the world is saving, real interest rates are going to be driven down. And I'm sorry you don't get a 10% rate of return on your wealth when everybody's trying to get 10% rate of return. So I think that's a tough thing, is, it's not clear to me how much of all these low interest rates are the actions of a central bank and how much of it is just these global forces on saving and searching for safe assets.
Well, okay. Professor John.
I have a question for Professor Liu. So now we see that Europe is pushing their QE and Japan is also pushing their QE, and the US has stopped and they may raise the interest rates. What are the implications for the financial markets in Asia? And what should investors respond?
So, yeah, okay. For Asia's financial market, or in general for Asia, I think Asia, I've been thinking this for quite some time. I think we are so innocent that we are really the victim of, sorry to say that, but of US and Europe's behavior for quite some time. Ever since 2008, what did we do wrong? I mean, we were just sitting home and working, I mean, as usual, but suddenly starting from Lehman, that the Asian market really got hit. And later on, there was QE. Okay, that was good for Asia because the money came to Asia. And so Asia had the stock market boom. Many people benefit out of it. Later on, there was a QE ending story. And then the money flooding out again. And so the Asia or the emerging market got hit again. So what have we been doing? I mean, we do nothing. It's just that we are all passive role. So for the Asian market, including the financial market, we really couldn't do much about it. It's really just, they come and they go. That's that. And then, but I think for one thing that Asia did learn, or at least some countries, they did learn some lessons out of this, which is that, in a way, it's our own fault that we were working so hard to boost exports into US and to Europe. That's why we got affected so much when they did something. And I think, so I'm very positive, including China's behavior recently and their infrastructure thing and many things. Okay, I think that Asia or the emerging market should really have another force in, so that we can, for the preparing for the future, whatever they do. Okay, I think that that's one thing, and especially that if we don't have to rely so much on exports for our GDP growth, I think that that's a necessity. At least that's the lesson we should learn from this whole thing. And then regarding the investment, I don't really have answer because the world is so turbulent and nobody knows who is doing what. But if we are talking about really very short term, then I would say, yeah, go for QE. Because QE, as I just mentioned briefly earlier, that it's something for real that they are printing money to buy something. But this something is not for some real good. So that's why we don't see inflation. So it's something for assets. And so you just follow that if it's really short term. But of course you have to be, you have to have strong heart. Because like me, I'm still preparing, I don't know which day, somewhere, somehow, something may happen. And this starting point, I would say, as Professor Waller just mentioned, that we don't know when the US would really start to have this interest rate rising, but it's going to happen for sure. And the part that we don't know is that we don't know how market will react to that. Because I believe so many people that now they are investing in US stock market, they knew that this won't last for long. So like 1987, that we see the stock market crash. And before the crash, for quite several years, people keep on saying it's overvalued. Somehow, somewhere, it will start to tumble, and it did happen. So sorry that I don't have any better suggestion to you, but at least my own feeling, I will feel that for something so uncertain, I mean, nowadays, that I think cash is king. Thank you.
Thank you. Professor?
question. Since we have two former finance ministers and no one central banker, since Waller says that this old monetarism was wrong, and then you seem to advocate this. At least printing money is not a bad idea. If that's the case, and then since finance ministers don't want to tax people because people always get mad when they tax people, so in that case, could it be the case that central bank print more money as substitute to reduce tax? Is that a good way to run the policy or not? At least could reduce consumption tax if both are kind of not dynamic efficient. And then is it possible for the central bank to print more money and ask the finance minister to reduce tax burden? Is that your advice or not? I'm not sure.
Well, that's, I have to take my central bank hat off to answer those kind of questions. No, I think this is exactly the thing is, as academics in theory, print money, go buy stuff, do this. All central banks are fairly restricted in what they can do, and for good reason. I mean, I've made this argument that if I've had people publicly say to me, you know, you guys don't know how to create inflation. We don't know how to do it anymore. And I thought, you know, the guy that used to run the Central Bank of Zimbabwe, he seemed to figure out how to create inflation. And if we don't know, we should hire that guy. But this is exactly the point. What we think of in our kind of simple principles classes is a helicopter drop. Print money, hand it out, or print money and just buy government goods with it, which is the way of alleviating tax burdens. We're not allowed to do that. So that would be a fiscal policy action in some sense. You know, the political authorities would have to say to the central bank, you have the freedom, as they did in Zimbabwe, you have the freedom to just go do this. I mean, it is kind of stunning if you had, I saw this calculation done, if you had taken all of the US QE and instead of buying government bonds or MBS, just gave a check to every US family, you would have given them $55,000. 1 year's income. So this is the kind of tax kind of. If giving people $55,000 in the U.S., which is 1 full year's income, if that doesn't cause inflation or spending or something, like I said, I give up. I don't know what. If you can do that, boy, you can really do a lot of things. I think there is limits to what you can do with this. But it's getting away from what we think about as monetary theory in our academic world and what actually central banks are very restricted in terms of what they can buy and what they can do. And for good reason, let me just say that. There's lots of good reasons. As we saw with Zimbabwe, we see why central banks are constrained this way. It's a good thing on average.
Well, will Professor know? Well, the panelist is supposed to answer questions.
Yeah, actually, I think that QE, I do see the effect, the real effect of QE. But I think that it only should be done when a country runs into a crisis, though. I don't think that's a good policy in general. So it's definitely not something can substitute for taxes. Definitely not. I think that QE, for the U.S. especially, I think that U.S., fortunately, that U.S. had QE. That's my belief. If U.S. did not implement QE in 2009, to start with QE, I think the world probably really run into very serious question even now. So I did agree, and I was happy to see U.S. implement QE. However, I think that QE is something really does a lot of bad things to the society. So any normal time that I don't think that any country should really implement QE. I think it's actually pardon to say that, but I think it's ridiculous. It's a ridiculous policy in general, because that's something that U.S. kept on saying for so long to Asian economy. Say central bank should be independent. You should not print money and buy your own debt.
But that's exactly what QE was doing. And for Japan, now that not only they are now doing QE seriously, but also they are doing QQE. That's not only that they buy government bonds, they buy their own stocks. That's even more ridiculous. I mean, the central bank or say the government could really do whatever they wanted to. And if that only, say, prevent bad things happen and lift up the economy growth, I think that was okay, at least for short term. But it's not so easy to end QE. So for US was really, I mean, I admire Bernanke very much so that before the end of his term, he started to saying this, that ending QE thing, even though the market was reacting very nervously, he still like implement this. So he started with, he started QE and he, in a way, ends QE. I think that's a beautiful circle. I really doubt any other country, later on, like Europe or Japan, they could do that. And for, like, say, China or any other country, I doubt it even more so. It's really not easy to end something. Printing money is so good for everybody. And what it creates, not only that the GDP thing, that it's only something justified when you are running into crisis. Other than that, I saw how this work becomes ever since we have QE, especially for the wealth effect. I think that's something so unfair. Because what we see is that we don't see inflation, we just see asset inflation, we see bubble. Who benefits from those bubble? For those who have access to it. And most of the people, or say on average, people don't have access to it. Like we watch the stock market, going up in the US for the past 6 years. How many of us like here that we benefit from it? Really very few, I believe. And even for the US, I have so many friends in the US, they did not invest in stocks at all for the past 6 years. Relatively, their wealth now is like the status is so different from like 6 years ago. And so I think this is not fair. And for tax, that's something at least we tax the wealthy people. And for this QE, it's like for those who have access to the financial market, they really benefit so much. And this is something probably for even a century cannot correct. Thank you.
Okay, thank you, Professor Liu. Mr. Peng, do you have any comments? He's from the central bank.
Very good. That's good.
Any questions, comments?
Actually, I didn't intend to express any opinion on the central bank policies because, first of all, I would like to thank Dr. Weller for giving us such a good presentations. I guess because I was in charge in exchange rate, I've been in charge in exchange rate policy. So I guess my boss want me to join this conference because he want me to learn a little bit about monetary policy also. It does create great concern for the central bank because the QE policy creates such a huge spillover effect to the Asian emerging market, especially for those countries who does not have robust economic fundamentals, such as India, Indonesia, and Turkey, to name a few. But also affect countries like Taiwan. Of course, we try to maintain the stability of our exchange rate policy because we want to anchor this exchange rate expectation coming from the capital inflow created by the QE policy. So in a way, I would like to ask Dr. Weller a question is that what would happen if in the future the Fed is going to stop the QE policy to the influence of the Asian country such as Taiwan, mainland China, or whatever, as well as their financial markets. Thanks.
Yeah, this has always been an issue when we undertook QE, particularly QE2 and mainly QE3. was emerging markets were complaining. There were this hot money capital flows in, and it was creating issues. Chairman Bernanke's point was, look, if this helps the U.S. economy grow, that's good for everybody in the world. A strong U.S. economy benefits everybody, particularly countries that export, because we're a big customer in the world. So if we're not doing well, we don't buy your stuff. So that was kind of Chairman Bernanke's view of it. And so what I always found interesting was the Fed was criticized for doing QE, and then it was criticized for stopping QE. And so no matter what we do, we're going to get criticized. I've learned that. But I have a question, and this is related to what you just said. I'd like to ask everybody, my colleagues up here at the front in the audience, should we lift off of zero? What's going to happen to your economies when we do? And should we do it or not? This is my question now I ask everybody. Don't ask me what we're going to do. I want you to tell me. What do you think? How many think the U.S. should lift off of zero this year? Raise your hand. Come on, be bold. Don't be afraid. Okay, two. How many think we should just stay at zero for the rest of the year? There's one hand. Yeah, I mean, this is the thing. I mean, I can imagine what I hear is that, with the U.S. Raises rates, this will cause capital outflows, which will be damaging. But at the same time, if the dollar appreciates, it helps your export sector. So it's not clear what this would do to emerging economies. Yes, it'll have this capital outflow, but it should benefit your export sectors. So this is always a problem with things like exchange rates. There's some good parts of it, and there's some bad parts of it. This is a debate in the U.S. right now about the strengthening dollar. People are all upset this is going to hurt all of our exports and create even more downward pressure on inflation. But by all the quantitative estimates I've seen, this has almost no effect on the U.S. economy. But in theory, it should have some marginal effects. But the U.S. is really a fairly closed economy when you look at, total net exports plus imports is a fraction of total GDP. It's less than 20%. And that's the sum of the two. If you take the difference, it's not that big. So, and that's why at least Jim and Bolt, my boss, and I, we don't think that the strengthening dollar is going to have that big of an economic effect on the U.S. It's not clear it will on other countries. And for Europe, if Europe wants to get better, this should help Europe, not hurt them. It's always been a puzzle to me why the euro was so strong all through the sovereign debt crisis. That was a mystery to me. Here's a monetary regime that looked like it could break down, and the value of the currency never wavered. Very amazing.
Okay, thank you. It's almost 15 minutes past 5. It's time for us to close the forum. And, oh yeah, okay.
Actually, I'm quite worried about the time inconsistent program. The policymaker always want to have more information, clear picture to make their decision. And they pay too little attention to the asset markets. And unfortunately, usually they get enough information. It's always too late.
So you're in favor of lifting off now?
Well, it's really a very good and a rare opportunity for us to listen to a real expert who knows the monetary policy of the U.S. and the thinking of the central bankers. I suppose all of us learned a lot from Professor Waller. May I invite you to show our appreciation to Professor Waller? And our appreciation also rests to the two panelists. Thank you. Thank you, you three. May I announce that the forum closed here? Okay, thank you for your participation. Thank you.